Did you know the mall retailer where you probably bought a used controller is placing massive billion-dollar side bets on the stock market? Welcome to the EDGAR Brief. Today, we're cracking open the Q1 2026 10Q from GameStop, ticker GME, filed on June 10, 2026, and we're translating it into plain English. Quick note before we jump in, we are independent, not SEC affiliated, and not financial advisors. We use AI to help summarize so errors can happen. Always verify on sec.gov before making any money decisions. Okay, let's start with a very curious hook buried deep in the footnotes of this latest filing. $983.3 million. That is exactly how much cash GameStop just pledged as collateral in a massive financial side bet on eBay. Yeah, it's wild. But before we unpack that unbelievable plot twist, we really need to understand their core operations. How do they actually make their money today?
The business model, or as I like to call it, a vending machine for pop culture. Let's dive right into what GameStop actually sells today and how the dollars flow through their doors. What's really interesting here is how much their business has fundamentally changed. Money comes in by taking a cut of every physical item that passes across their counters, and the money goes out to cover inventory, rent, and store staff. And as you can see, they're now generating way more revenue from collectibles, apparel, and toys, coming in at $348.9 million, than from actual video games and software. Hardware and consoles still make up a healthy $333.7 million, but that high-margin physical software business, it's shrunk to just $152.7 million. So basically, GameStop is a physical vending machine that makes money by taking a slice of pop culture merchandise sales.
Section 2. The Quarterly Scorecard. Separating Fact from Fiction. The most important question for any retailer is simply this: are more dollars walking in the door compared to last year? The answer is a resounding yes. We're looking at a classic turnaround frame here for the physical stores. Top-line revenue is up from $732.4 million last year to $835.3 million this year. Gross profit, which asks for every dollar sold, how much sticks around after paying for the actual products, but before paying for rent and payroll, that's also up significantly. But the most vital number here is operating income. This is the profit from the actual everyday business of running stores, before any financing tricks. Last year, they lost $10.8 million operating their stores. This year, that flipped to a very real $143.3 million in store profit. The core business is bleeding no more.
But here is where we have to be super careful. If you look at their headline net income on the income statement, it sits at an enormous $389.6 million. That is much, much larger than the $143 million they actually made ringing up customers at the cash register. We need to separate this accounting fiction from the cash reality of the stores. Because where did that extra $246 million magically come from?
That brings us to Section 3, the eBay plot twist, also known as the Dragon's Hoard. That gap between the store profit and the total net income leads us directly into the wildest part of this SEC filing. GameStop isn't just a retailer anymore. It's acting like a vault. Management revealed in the footnotes that they have amassed an incredible $7.39 billion in cash and cash equivalents. And they decided to take a huge chunk of that cash and quietly acquire an approximate 5% economic interest in eBay. But they didn't just log into a brokerage account and buy regular shares of eBay. No, they used derivatives, specifically instruments called put/call pairs. If you don't speak Wall Street, let's translate this simply. It's a highly complex financial bet on the future direction of another company's stock price. It gives them the economic exposure of owning millions of shares without directly buying them outright today.
Let's see how this builds in reality. Step 1, GameStop locked up nearly $1 billion, that $983.3 million we mentioned, as collateral with a counterparty. Step 2, in exchange, they gained the economic exposure of over 22 million eBay shares. Step 3, they plan to settle up the final profits or losses in cash by the time these contracts expire in 2028. It is literally a massive, multi-year, billion-dollar side quest.
So the crucial point is this. Because eBay's stock did well during this specific quarter, accounting rules require GameStop to record the increased value of that bet on their income statement. This side bet generated $285.3 million in unrealized paper gains. It hasn't cashed out yet, but it artificially pumped up their net income far beyond what the retail stores actually produced. Always remember, profit can be fiction, but cash from the register isn't. Section 4. Checking the moat, the scale game.
Ignoring the investment fund's side quests for a second, what actually protects their retail business from being crushed by competitors tomorrow?
Well, GameStop is playing a scale game. Their durable advantage, their moat, is their massive physical brand presence and their GameStop Pro subscription loyalty program. Customers know the brand, but reading between the lines of management's discussion, there are serious vulnerabilities here. They face a massive headwind from digital toll booths. Console makers like Sony and Microsoft are pushing gamers to download games directly, cutting GameStop entirely out of the transaction. Because of this pressure, GameStop is shrinking to survive. They've already sold off their Canadian operations, and this filing shows they've listed their French stores as held for sale. They are retreating to their strongest borders.
Section 5. Red Flags and Risks. The Elephant in the Room. Now, Item 1A in any SEC filing is written by lawyers to cover absolutely everything up to and including an asteroid strike. We need to separate the standard boilerplate from the actual immediate threats to this specific business right now.
And looking at the balance sheet, there is a giant elephant in the room. The biggest red flag by far is their $4.16 billion in long-term debt. Yes, they have over $7 billion in cash, so if revenue stopped tomorrow, they could keep the lights on for a while, but they owe over $4 billion in debt stemming from notes that come due in 2030 and 2032.
Now, these aren't standard bank loans. They're convertible notes. That simply means they are loans the lender can eventually swap for company shares if the stock price hits a certain level. Right now, GameStop is earning enough interest on its cash hoard to offset this. But if the retail business ever stumbles, or if interest rates plunge, servicing that $4 billion mountain of debt is going to become a very real, very heavy burden.
Section 6, the bottom line, and our verdict. We've waded through the numbers, the derivative bets, and the debt. Let's pull this all together and translate what you should actually take away from this EDGAR brief.
Ultimately, GameStop is a physical retailer showing genuine operating improvements. Their main strength is an absolutely staggering $7.39 billion in pure cash equivalents. And the main thing to watch is their balance sheet, which looks less like a normal store and more like a dragon's hoard, weighed down by $4.16 billion in debt and highly unusual, complex market bets on other companies like eBay. For the next filing, we'll want to track 3 specific things: store operating income, the status of that massive eBay bet, and whether they take on or pay off any more debt. As you look over this filing, I leave you with this final thought to ponder. Looking at these numbers, the massive cash pile and the derivative trading, is GameStop still a retailer? Or have they effectively become an investment fund that just happens to sell Funko Pops on the side? That's your EDGAR brief on GameStop. This was a translation, not a recommendation. Read the original on sec.gov if anything piqued your interest. Thanks for being with us at the EDGAR brief. See you in the next filing.